Looking to build steady, hands-off income through real estate? Real estate investment trusts, or REITs, could be your perfect solution. In this ultimate guide, we'll explore how REITs work, why they're a smart choice for generating passive income, and how to get started investing in them. Whether you're a beginner or looking to diversify your portfolio, this guide will help you unlock the power of real estate without the hassle of managing properties yourself. Let's dive in. Today we will talk about the ultimate guide to REITs for passive income. So before we start, make sure to hit the like button and subscribe to my channel. 1. What are REITs and how do they work? Real estate investment trusts, REITs, are companies that own, operate, or finance income-generating real estate. They allow individual investors to invest in large-scale commercial properties without directly owning or managing them. REITs generate income primarily from rent and property sales, and must distribute at least 90% of taxable income to shareholders as dividends, making them attractive for passive income. They trade on major stock exchanges like regular stocks, providing liquidity and easy access. REITs come in different types: equity REITs, own properties; mortgage REITs, finance properties; and hybrid REITs, combine both. Investing in REITs provides diversification across property types such as residential, retail, industrial, and healthcare. Understanding how REITs operate helps investors tap into real estate's benefits while avoiding the hassles of property management. 2. Types of REITs and their investment profiles. There are primarily three types of REITs: equity, mortgage, and hybrid. Equity REITs own and manage properties, earning revenue mainly from rent. They tend to have stable income streams and potential for property appreciation. Mortgage REITs, however, invest in real estate loans and mortgages, earning from interest payments. They are often more sensitive to interest rate fluctuations and can be riskier, but may offer higher yields. Hybrid REITs combine aspects of both equity and mortgage REITs, balancing income sources and risk. Additionally, REITs focus on various sectors, such as commercial office spaces, shopping centers, apartments, industrial warehouses, and specialized properties like data centers or healthcare facilities. Each sector has distinct market dynamics and risk-return profiles. Choosing the right type and sector depends on your investment goals and risk tolerance. 3. How REITs generate passive income. REITs are designed to provide consistent passive income through dividend payments, which come from rental earnings or mortgage interest. Because REITs must distribute at least 90% of taxable income, they typically offer higher dividend yields than many stocks. This makes them attractive to income-focused investors seeking regular cash flow without actively managing properties. The dividends are usually paid quarterly, providing predictable income. Over time, some REITs may also increase dividends if property values and rents rise. Moreover, investors can benefit from potential capital appreciation as property values increase, although this is often secondary to dividend income. REITs thus offer a blend of income and growth, making them suitable for long-term passive income strategies. 4. Benefits of investing in REITs. Investing in REITs offers several advantages. Firstly, they provide diversification within a portfolio by adding real estate exposure, which often behaves differently from stocks and bonds. This diversification helps reduce overall portfolio volatility. Secondly, REITs offer liquidity since they are publicly traded on stock exchanges, unlike direct real estate investments that can take months or years to sell. Thirdly, REITs allow investors to start with small amounts of capital, making real estate accessible to a wider audience. Fourthly, REITs often provide attractive dividend yields, delivering steady income streams. Finally, investing in professionally managed REITs shifts the responsibility of property acquisition, maintenance, and tenant management from the investor to experienced teams, making it truly passive. 5. Risks and challenges of REIT investing. While REITs offer many benefits, they also come with risks. Interest rate sensitivity is a major concern, especially for mortgage REITs, as rising rates can increase borrowing costs and reduce dividend payouts. Market volatility affects publicly traded REITs, causing share price fluctuations unrelated to underlying property values. Economic downturns or changes in real estate demand can reduce rental income and property values, impacting distributions. Sector-specific risks exist too. For example, retail REITs face challenges from e-commerce growth, while office REITs can be affected by remote work trends. Additionally, REIT dividends are taxed as ordinary income, which may be higher than qualified dividends or capital gains, impacting after-tax returns. Understanding and managing these risks is essential for successful REIT investing. 6. How to analyze and choose REITs. Selecting the right REITs requires careful analysis. Key factors include dividend yield, payout ratio, funds from operations, FFO, and net asset value, NAV. Dividend yield indicates current income, but extremely high yields might signal risk. Payout ratio, dividends divided by FFO, shows dividend sustainability. Ratios above 100% may be unsustainable long-term. FFO is a critical metric unique to REITs, reflecting cash generated from operations, excluding depreciation. NAV estimates the value of underlying real estate assets. Review management quality, historical performance, debt levels, and portfolio diversification. Consider the REIT sector and geographic focus to align with market conditions and personal risk tolerance. Finally, diversify your REIT holdings to mitigate sector-specific risks and ensure steady income streams. 7. Tax considerations for REIT investors. REIT dividends are typically taxed as ordinary income, which may be at a higher rate than qualified dividends or long-term capital gains, potentially increasing your tax bill. However, under the U.S. Tax Cuts and Jobs Act, investors can often deduct up to 20% of REIT dividend income, reducing taxable income. Additionally, investing through tax-advantaged accounts like IRAs or 401(k)s can defer or eliminate taxes on dividends. Be aware of state and local taxes, which can vary. REITs may also generate capital gains distributions when properties are sold. 8. How to get started investing in REITs. Getting started with REITs is straightforward. Many brokerages offer publicly traded REITs, which can be bought and sold like stocks. You can invest in individual REITs to target specific sectors or geographic areas, or choose REIT mutual funds and ETFs to gain broad exposure and diversification with a single purchase. Begin by defining your investment goals, risk tolerance, and income needs. Research different REITs or funds based on their yield, growth prospects, fees, and management. Consider dollar cost averaging, investing a fixed amount regularly to reduce timing risk. Monitor your investments periodically and rebalance as needed. 9. Future trends and the outlook for REITs. The future of REITs looks promising, but is influenced by evolving market trends and economic factors. Technological advancements, such as PropTech and data analytics, are improving property management efficiency and tenant experiences, potentially boosting REIT performance. Demographic shifts, including aging populations, increase demand for healthcare and senior housing REITs. However, changing work patterns, especially remote work, challenge office REITs, while e-commerce growth pressures retail REITs to adapt through innovative uses like logistics and fulfillment centers. Interest rate environments remain a critical factor. Rising rates can increase borrowing costs, but may also reflect a strong economy that supports rental growth. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.